Hello beautiful people, welcome back to the channel. If you are new here, my name is Elizabeth, and in today's video we are going to talk about a financial plan and why you need one. A financial plan makes your intentions clear of what you want to do with your money. It really gives a picture of what are your goals. Where do you want to go when it comes to your money? What do you want to achieve? Where are you currently? And what are you doing to change your financial standing to move from point A to point B? A financial plan is like a promise to yourself, a written promise to yourself in terms of how does your money move and where does your money go. So it gives you that clear picture of the movement of your money in and out of your accounts. A financial plan is a living document that actually indicates how you earn, how you spend, and how you grow your money, and it needs to be constantly updated as your life is changing. Like I said in a previous video, our lives keep changing, and as such, then needs, our goals, our wants also change as our lives are changing. So your financial plan cannot be a document that is like very stagnant. It has to be a living document that you are constantly making adjustments to in order to make room for the changes in your life. We will now go through the key components that makes up a financial plan, and one can see whether you are on track with those different parts, whether you have a financial plan and whether you are on track with the different parts that should be included in your financial plan. Yeah, this is more like a breakdown basically of the different things that you need to consider when you are doing your financial plan. Of course, our financial plans will differ from person to person, but there are some key elements that can be found in our plans of different people. The first part of your financial plan is the part where you calculate your net worth. You need to know your worth. For you to know where you are going, you need to understand where you are right now. And right now, you need to have an understanding of what am I worth? What are my assets? And what are my liabilities? What are the things that I own? And what are the things that I owe? So that you are able to get what is it that when these two subtracted from each other, what are you having left? And that is your net worth. So with your net worth, you look at your assets versus your liabilities. So if you have assets that once you have done the calculation are worth 100,000, then you look at how much it is that you owe, what are you busy paying back, and let's say you are paying back 50,000 worth of debt, for example, then the difference between the two is 50,000. So then your net worth will be 50,000. That calculation you do with your own time, and you look at really everything. You look at those store accounts. You look at that other loan that you took when you went to Swakop, and you look at your student loans. You basically look at everything that you owe, every little thing that you owe. So then you look at those things versus the things that you actually own. So you look at what you owe versus the things that you own, and you will know the difference between the two is actually your net worth. Now, after you do your net worth calculation, you can either surprise yourself in a good way, or you can surprise yourself in not such a good way. And I say that because sometimes we think we are doing really bad. We think like, oh my goodness, I'm so behind, my peers are this and that, they are doing this, they have that. And we don't always take a break to look at, okay, what about me? What do I have? So sometimes when you do this net worth calculation, you actually realize that, oh, okay, things are not as bad as I thought, There's actually something good in here. But then it can also be the opposite. It can also be that you thought you are doing so well and you are worth so much more, but then after you did the calculation, you realized that there were certain aspects of your liabilities that you were neglecting and that you were not paying attention to. So the picture is not as rosy as you thought it would be. So prepare yourself to be surprised when you're doing this part, and it's a normal part of the process. The second component is having a budget. So once you have seen what your net worth is, then you draw up a budget. Now that budget is how you manage your cash flow, how you manage the money in and out of your accounts. The budget shows you where your money is going, where your money is coming from, where your money is going. For me, when it comes to your budget, you need to at least have 4 to 5 key things that are covered in your budget. Of course, you have your income. You indicate how much you are earning and the different sources that it's coming from. That is fine. But in terms of where the money goes now after it hits your bank account, for me, I feel the first pot that it needs to go into is your needs, your basic needs. This is where your payment for your home is, whether you are leasing your home or you are the owner and you have a mortgage on it. This is where your electricity is. This is where your utilities are. This is where things like your Wi-Fi is, and other needs for other things that are key needs in your life. They go in there. So you allocate money to that. Then the second thing that you allocate money to is your wants. What are the things that are your wants? I want to have a massage once a month. Tick, you allocate. I want to be able to buy and read 1 book a month. Tick, you give an amount to that. You put that under your wants. You want to have a facial, you want to have your lashes done, you want a new pair of shoes, it goes into wants. Then you must have now your investment pot. Now your investment pot, in fact, in terms of how the money leaves your account, the investment pot things must leave first from your account before any other thing. And that is what I call paying yourself first. So you have your investment pot where you have different accounts or different places where you are putting your money, where you have some savings and you have some investments that you are making with your money. So that is that savings and investment pot. You can call it your freedom fund, or you can call it your, whatever that you want to call it. But basically it's where the money is leaving your account to go to your savings and your investments. Then the fourth one for me, and it's very important especially for us as Africans, is the charity or family support, or whatever, how you want to name it, that pot where you allocate money to help other people. If you are helping your cousin's child or your sister's child or your sibling or your parents or a charity, whoever you are giving support to, that money is allocated under that pot, and that is your giving back money. You are giving back to others in that pot. And then the fifth pot is the pot now for your personal development. Very important. How am I developing my skills, upskilling myself? And you allocate money in that pot. If you see a course that you like, like short courses, you can allocate money in that pot for those type of things. For you to go to an important business seminar or indaba or whatever, you allocate in there. It's your savings and investment pot, it's your basic needs pot, it's your wants, and it's your giving back pot, and it's your self-development pot. So I spoke about 5 pots that should be in your budget. And like I said, in terms of how the money flows, your savings and investment allocation should go out first. Set it up so that it's automatic. You don't have to manually, put it in, and it must go first, followed by your needs, and then followed by your wants, and then your charity, and of course your personal development. And remember, when it comes to the charity pot, don't overextend yourself just to try and help another person, because now you are creating a need also within yourself that someone needs to assist you. So as much as it's nice to give back, it's nice to help others, it's also nicer to make sure that you are okay and you are not overstretched, just so that you can provide for your extended family, for example. Giving is good, it's good to help others, but let us not do it at the expense where we are not able to sleep well at night because we are stressed with our money while we have given back. So the third component of your financial plan is managing debt. And managing debt, we have, like I said, when we have done our net worth calculation, we have to be honest and realistic about what do we owe. And we need to write down our debts. We write down and start paying off in either two ways. We can write down from the one with the highest interest to the one with the lowest interest. Or we do it with the one with the highest amount that we owe to the one with the lowest amount that you owe. So from my personal view, it's more important for you to pay off your debt, the one that you have the highest interest first, compared to the one where you have the highest amount. Because the interest will keep compounding against you. It will keep going up in the reverse position. So it's important to make sure that the debts where you are paying the most interest, you prioritize them first so that you pay them off first. Then you go down, as you go. For example, your store cards, your credit cards, your loan shark, those type of debts, you need to prioritize paying them off first. Because when you look at debts like your student loans, the interest rates, they are quite low. So it can be the last one that you prioritize. It's up to you whether you want to be paying a little into each, or you want to first target one or a few until you finish it off and then you tackle the others. But it also depends on how your loans are structured and how you want to go about things. The fourth component in your financial plan is making sure that you have emergency savings. Most of the people recommend 3 to 6 months of your expenses, not your income, but of your expenses. However, depending on what your targets are or what your goals are, you might want to consider 6 to 12 months of your expenses. For example, if you just want to have a funded emergency, to just have an emergency fund where if you have a car breakdown, you are able to something which is not covered, of course, by your insurance. But if it's something that is not covered by insurance and you have an issue with your car, you are able to sort that out. If you have a family emergency, you are able to sort that out. Then it's fine to have a 3 to 6 months. But if you are somebody who is looking at different job options, for example, or you are looking at moving jobs, or hopping between different, industries and things like that, then you might want to consider more than 6 months, maybe up to 12 months, so that you have enough room to make certain decisions when it comes to your career and all of that. So make sure, emergency fund, very important. It keeps you, it keeps you from a lot of unnecessary stress. And you have a peace of mind, you are able to sleep comfortably knowing if you wake up tomorrow and there's this each thing that needs money, you are able to just transfer those funds or put in a request with your bank to have those funds transferred to you, and you can sort out that financial problem. It gives you that power to handle your own without having to borrow and without having to bother other people. At number 5, a component that you need to also consider for your financial plan is saving for big purchases. For example, if you want to buy a car, let's say you just started working, you are a young professional and you are thinking you would like to buy a car, you don't want to foot anymore, you need to plan for that car. And I personally would make sure first that I research the cars that I want and I have at least a few options to consider. And once I have zoomed in on an option, I look at how much I need to be paying for the vehicle on a monthly basis, including insurance, including fuel and other small maintenances, then that amount of money should be put aside at least for 3 months or for 5 months. Practice putting that amount of money aside in a different account every month, as if you are paying it to the bank. Put it away. See how you manage with your budget before you actually go ahead and commit to this big purchase, which is a car. And if you see you are not managing while you are just putting the money elsewhere, then clearly you need to revise and look at whether that is still the car that you want, whether that is still the car that you want, or you want to reconsider going to a car that is much more affordable to you. It always looks easy and people only look at your monthly charge from the bank or monthly deduction from the bank, but it's more than that. And once you really run your numbers correctly, then you will have a better view of where are you, what can you afford, what can you in reality afford. If you practice putting those funds away, you will have a better understanding of whether it's doable for you or you need to relook at a different option. Component number 6 of your financial plan should be retirement planning. We need to plan for retirement. Even if you are just starting to work, you are in your early 20s, that is actually the best time to start. It looks like it's very, very far, but the way life is, the years goes by so fast. And next thing you know, you are close to your retirement and maybe you haven't done enough to put money aside to make sure that you are comfortable in your old age. So it's important to already start. If you have an employer retirement fund, contribute to that. If you have a match, even better, make use of that, make sure you are fully benefiting from that. And if you don't have from your employer, then you can get one from an independent provider. But whatever it is, make sure that you are putting money aside for your future self, for your older self. You want to make sure that your older self is comfortable and is living well. Component number 7 is about insurance. And I have spoken about insurance in a previous video also. So we need to make sure that yourself, which is your biggest asset, is insured. And any other assets that you own, you need to make sure that they are insured. Be it your car, be it your home, be it equipment, be it anything that is of value that you own that can be insured. Please make sure that you have insurance to cover you in times of need. So it's important to make sure that we have cover and not run around when things go wrong. Part of drawing up your financial plan is also making sure that you understand your risk profile. There are people who want big returns, fast returns at whatever cost. But there are also people who will say, I don't feel comfortable putting money in this unpredictable thing. I want to put my money in something that is a bit more predictable and I have a bit more control or a bit more oversight or whatever the case might be. So having that understanding of what type of person you are in terms of your savings and investments, it will really help you to choose where to put your money. Just because you had your friends putting money into Forex, it does not mean, if it's not your kind of risk appetite, it does not mean you have to follow your friends. Or you might want to follow your friends who are putting money in government bonds. So have a better understanding, do some research, have a better understanding of what type of investor are you and what is your risk profile when it comes to where you put your money and what growth and what risks are there for you. At number 9, your financial plan should have the investment component. I touched on a little bit about investment in the previous point, but here we need to make sure that we are saving and investing, and we need to decide where is this money going. Remember, from our budget, from the saving and investment pot, one actually has to decide where is this money going when it's leaving my account. Is it going to a unit trust? Is it going to a money market account? Is it going to government bonds? Is it going to a mutual fund? Is it going into equities that I'm buying through a broker, where I am doing my investment myself, or am I giving it to a broker who is an active manager and they do everything and they only give me statements? Once you know your risk profile, you are able to make those decisions in terms of your money. And if you feel like you do not have enough knowledge to make those decisions, go to a financial professional, so that you can get the information from someone who is certified and licensed to do so. There is nothing wrong with going to a professional to be guided on moving forward. Just make sure it's somebody who is certified and they are registered to do that. And another thing to make sure of is that it's better for you to go to financial professionals, for example, advisors, who are charging you a rate instead of a percentage. Somebody who has a flat rate of saying, if I'm seeing you, this is how long I'm seeing you, and this is how much I'm charging you for that appointment. Compared to somebody who say, oh sure, I can help you. Just give me 2% of the money that is leaving your savings and investment pot. For me, the percentage thing, that is my view, but it's up to you to decide what to do with your money and how you deal with things. Component number 10, understand your taxes. I know taxes are hard. They are not always easy to understand, but as adults, it's our responsibility to learn about our taxes, to have a better understanding about our taxes. Consult a tax consultant or professional if there's a need. Let them explain things to you. Even if they are assisting you to file, make sure you understand what they are filing. There is no shame in going to a professional and admitting, I do not understand or I do not know these things. There is no shame in that. That's why we have these professionals. Let's make use of it. However, make sure you understand your own finances. You understand your taxes. You understand your tax brackets. You understand your income and what you are supposed to pay. Don't just blindly have someone file your taxes without even you having a clue of what is going on. So it's still your responsibility as an adult, as a taxpayer, to make sure that you understand and you are filing correctly and you don't owe the taxman anything. Component number 11, which is our last one, you need to plan for wealth transfer. Plan for how you are transferring your money to the next person in an event. Either you are there or you are not there. So this is your estate planning. If you have children, how are you planning to pass down that money to your kids? And this is not just about when you are no longer there and they are inheriting everything. It's also while you are there. How are you slowly passing on your assets or your wealth to your children? Or to anybody if you don't have kids and you want to transfer your wealth. And even when you are not here, it must be very clear how will your wealth be transferred to the next person or the people that you have chosen to benefit from your estate. And that brings in the importance of having a will. I know many of us are adulting without wills. And guys, we need to make sure that we get our wills done. Life is so unpredictable. We don't know how much time we have. We don't know what will happen tomorrow. Let us have our wills in place. You do not want your money to go to that cousin who used to hit you when you guys used to go to school. You don't want your money to go to that aunt who refused to, give you a meal when you visited her. You don't want your money to go to the people who hated your mom and made your mom miserable because they are hazing the in-law. But I digress, but those are just some of the examples to say, look, you want your money to go to the people that you have chosen yourself, and in what proportions do they benefit from your estate. So it's important to make sure that we have our wills in place, but besides the will, how are you transferring your wealth to your beneficiaries while you are still alive? So let's consider that. Now, for your financial plan to work, you have to be really intentional about the things that you are trying to do. And you have to put in the work, and you have to keep coming back to your plan and making changes as necessary. The plan only works if you work. If you just plan and leave it there and enjoy your life without putting in the work on the things that you say you want to do, the plan will not work. So let's be intentional. Let's have our financial plans. Let's have our budget, which is part of our financial planning. And let's make sure that whatever money is coming in our accounts is allocated appropriately, and it's going to the places that we really need it to go, and it's for the benefit of us currently and also for our benefit in the future. If you have found value in this video, remember, as usual, leave a comment, like and subscribe to the channel, and I will see you in the next one.